Welcome to This Explainer. You know that mortgage rate you see plastered on a bank's window or advertised online? There's actually a massive, completely invisible machine running behind it. Today, we're going to demystify that complex financial machinery that directly dictates your monthly housing costs. What's happening behind the scenes is honestly an absolute masterclass in global finance.
So what actually makes up your mortgage rate? A lot of us just assume a local bank looks at our credit score and, picks a number. But in reality, your rate is the final product of a massive, globally interconnected system. We're talking institutional investors, government agencies, and complex market liquidity. Today, we're going to peel back all of those hidden layers. We're going to unpack this whole thing in 4 quick steps. First up, anatomy of a mortgage rate. Second, recapitalizing GSEs and your rate. Third, who owns mortgage-backed securities. And finally, number 4, why market liquidity matters.
All right, let's jump right into Section 1, Anatomy of a Mortgage Rate, peeling back the layers.
Okay, think of your mortgage rate kind of like building a house. Your foundation is the 10-year Treasury rate. That's basically the baseline cost of borrowing money in the U.S. economy. Right on top of that is the secondary mortgage spread. Think of that as the framing of the house. And finally, the primary-secondary spread acts as the roof that completes your rate. Let's zoom in on that framing layer for a second. Now, you might be wondering, why does this secondary spread even exist? Well, investors who buy mortgage-backed securities, or MBS, are taking on risks that just don't exist with basic treasuries. They need to be compensated for things like prepayment costs. Finance geeks actually call this negative convexity, which really just means you might pay off your loan early when rates drop. This spread is also driven by basic supply and demand, plus liquidity considerations.
And that brings us to the roof, the primary-secondary spread. This is the difference between that MBS rate and the actual rate you, the borrower, pay at the end of the day. This layer is where all the secret markups live. We're talking guarantee fees, higher than ordinary servicing costs, and of course, the originator's profit margins. Interestingly enough, shifts in these specific costs are exactly what have caused mortgage spreads to shrink as we look at the market moving from 2025 into 2026.
Moving right along to Section 2, recapitalizing GSEs and your rate, the cost of release.
Remember those guarantee fees or G fees we just talked about? They are a massive piece of the puzzle here. To give you some context, they currently sit at 64 basis points for Fannie Mae and 67 for Freddie Mac. Those are our 2 primary government-sponsored enterprises, or GSEs. That fee pays for a lot. It covers expected credit losses, administrative expenses, congressional surcharges, and crucially, the cost of capital. In fact, that required rate of return on capital is the single largest component of the whole G fee.
And here's where it literally hits your wallet, 10 to 25 basis points. If administrative actions bring these enterprises out of conservatorship, a process known in the industry as recap and release, they have to transition from a safe, utility-like rate of return to a much more demanding market rate of return on their capital. Because investors are going to demand higher returns, that shift alone would drive up your consumer mortgage rate by up to 0.25%. Let's look at the players behind all this in Section 3. Who owns mortgage-backed securities? The heavy hands.
Just wrap your head around this number for a second. $9.1 trillion. Trillion with a T. As of the third quarter of 2024, that is the staggering scale of the agency mortgage-backed securities market. It is literally one of the largest, most critical fixed-income markets on the entire planet. But it begs the question, who actually holds all this debt?
When we break that $9.1 trillion down, it's pretty wild. U.S. depository institutions, basically the banks, hold exactly 35% of the pie. And right behind them, the Federal Reserve holds almost 25%. Think about that. Banks and the Fed control nearly 60% of the entire market. When you have ownership that heavily concentrated, any regulatory or administrative action those top players take is going to profoundly impact supply and demand.
And because of that extreme concentration, any shifts in the landscape create huge ripple effects. If we recapitalize the GSEs, or if bank capital rules change, or even if the Fed just alters its purchasing habits, it introduces speculation. And let me tell you, in a $9.1 trillion market, speculation can absolutely shake the foundation of mortgage pricing.
Which leads us perfectly into our final section, Section 4, Why Market Liquidity Matters, Keeping the Gears Turning. So liquidity is basically just how fast you can buy or sell an asset without completely wrecking its price. We usually measure this by looking at the bid-ask spread. For every $100, U.S. Treasuries are hyperliquid, sitting at just over 1.5 cents. But right in the middle, we have agency MBS at about 3 cents. Now compare that to corporate bonds, which are at nearly 44 cents. This proves just how uniquely high and highly liquid mortgage trading volume really is. It's second only to U.S. Treasuries. But how are mortgages so incredibly liquid? Well, it's all thanks to something called the to-be-announced, or TBA market. This is a brilliant forward trading mechanism. It actually allows mortgage originators to bundle and trade loans months before the actual mortgages settle or before the paperwork is even finalized. That mechanism is what generates this massive, continuous trading volume.
Let's pause for a quick so what moment here, right where high-level finance actually meets your living room. Without the liquidity provided by that TBA market, everyday borrowers, like you and me, literally would not be able to lock in a mortgage rate while waiting a month or two to close on a new home. This complex trading mechanism is exactly what gives you that financial certainty during what is already a super stressful home buying process.
Which brings us to our final thought for this explainer. We've seen just how delicate all these layers are, from that Treasury foundation all the way up to the G-fee roof, not to mention the massive institutions holding this $9.1 trillion market together. So if administrative actions, like GSE recapitalization or shifting bank capital rules, end up altering this foundation of mortgage liquidity, what does the future of home affordability look like? It's a massive, complex puzzle. But hey, now you have the visual roadmap to understand exactly how the invisible machinery of your mortgage rate actually works. Keep an eye on those spreads, and thanks so much for learning with us today.